China market earnings and valuation, this is price to book, versus ROE. And I like this chart because it got everyone. It got, the emerging market, developed market, MSCI China Asia onshore, MSCI China. So, China, the red dot right now is on the so-called attractive level, from a ROE perspective, 10% each. But in terms of the trailing price to book is on the low level, right? It's about, 1.2x if you like. And then on the top right-hand part, the two dots, one is obviously, US, the ROE is really high, 18 to 90%. But my personal judgment is except Nvidia, the Magnificent Seven, the tech company, how sustainable is the ROE, down the road, in particular in the deglobalization world, because they are facing inflation problem, they are facing high wages, and they are also facing maybe competition from the global products. So my personal, for example, Apple, they're losing market shares, in China. So whether their ROE could be that high down the road, I have a question. But it's not cheap, in terms of price to book, it's 4x. I think India is in a different situation, but I think historically the valuation relative is higher, so is in a relative, basis point. But besides these two countries, I think there are also a lot of group like, Taiwan, Australia, the ROE is slightly higher, but they are 2x to 3x. My estimation is the ROE and earnings in China Asia is underestimated by the market. So, down the road, if the earnings pick up quickly, the ROE could be, right on the right-hand side, in a quick manner. Then it would be super attractive, like Colombia, I've never been and invest in Colombia before, but just looking at this dot, you see, it's high ROE and low valuation. But joking aside, I think the market underestimate the earnings, if you like. And then Hong Kong, on the other hand, the return is quite low. The ROE, if you like, is only 5.8%, if you like, trading at 1x price to book. So relatively speaking, if we compare the domestic China, MSCI China onshore, MSCI China compared to the Hong Kong market, that's why it's also one reason I said you should go directly to the China A shares, rather than investing in the Hong Kong shares, because from a earning or ROE perspective is in that manner. So this is more factual, comparison in the market. I see a question, maybe I'll just, try to take a quick look. Chinese banking sector and then US listed Chinese stock, major political. So yeah, maybe I'll answer that in the investment theme part. I think part of the question is also tied into the conversation that I'm going to, discuss. But I'll finish, the flow right here first. This is the market earnings and valuation since we are in this topic. We are seeing that MSCI China, again, 10 times PE, but compared to the MSCI emerging market is, 20%, discount, if you like, and close to 1%, standard deviation cheaper than the average. So basically, is in the so-called, I would say, sweet spot. But interesting enough, if you look at the rebound, which is the red line, because of the market rally, actually the forward PE, the MSCI China has go up. If we are talking about the same topic, for the same chart early on this year, actually the red line is much below, meaning that is in a very, very, cheap areas. That's why if you look at my global media interview, late last year, early this year, we think, China is very attractive from valuation, earnings, etc. perspective. Is because from a historical perspective, you see in terms of, a valuation, in terms of PE or valuation, the discount is already in a big discount. So if you look at this chart, the light blue chart is actually the price to earnings ratio discount. So the historical bottom was around 30% in January this year. The gap has been closed a little bit. Right now it's 90%. Is because the rally of the Hong Kong shares, starting in mid-April. But I think the discount will come back, to a narrower range.